Coming in after a Diwali break. Hopefully, you all had a very good Diwali break, and I think it's a good time to discuss about personal finance after Diwali. And here I'm happy to have Picasso Baumek. He's a certified financial planner, but added to it, he's also a chief manager is in a bank. So he combines both, so you can't get any better than Picasso to talk about financial planning and how we can simplify the financial planning and everything. So I'm going to start with some of the questions that I have and some of the questions that have come to me earlier. But if you have any questions, please put it on chat, and then I will give you opportunities, or you can raise on the Zoom itself. You can raise your hands, and then I will ask you, and I'll give you an opportunity, and then we can discuss with that. So first of all, Picasso, thank you for joining in. Thank you for agreeing to do this. Thank you very much for this.
Thank you so much, Joseph. I think it's my privilege to be on your show. I have been following you in Clubhouse for some time.
Yeah.
And I could get an opportunity to attend one of your sessions. So I think it's really an honor, privilege for me. So thank you so much for having me.
Good to have you, Picasso. And thanks. I want to take this opportunity also to thank KK, who introduced you to me, and then it has grown from there. So KK is also here. He has joined at the exact time. So thank you, KK, for coming in.
Thank you. Looking forward.
Yeah, I hope you are safe in Chennai there.
Yeah. For now,
wonderful.
safe.
Wonderful. Okay. Again, I'm repeating this. If any of you have any questions, please put it on chat, and then we can take it up from there. He's there to answer all our questions. Because when we are talking about personal finance, what are all the things that comes under personal finance, and how should I think about that personal finance?
Okay, good evening, everyone. Thanks for joining. So before I start, I'd like to give two disclaimers. Number one is that whatever I'm going to talk here, not as a certified financial planner or banker, I'm going to share my own experiences. And because I have been into this financial planning before I joined the bank, so some of my friends and colleagues and relatives have kept on having discussions back and forth on financial planning issues. So my experiences cumulatively is not only my own experiences of my personal financial life, it is also the financial lives of other people that I have been talking to. So it's a cumulative experience that based on which I am going to share. So I'm not here to give GANs on financial plan and all. It's basically a discussion where I'm sharing my stories, and maybe you can share your stories. That's one. And second is personal finance, as the name suggests, is very personal to everyone. So whatever I say is something which is of generalized frameworks, and whatever I say, if you do not agree with that, or you need to think of it as that something, whatever I say, you need to take it with a pinch of salt, because it may not exactly fit into your circumstances. So it's very personal for all of us. So it's totally it depends on person to person, but whatever I'm going to say is a very general, from a general perspective. So to answer to what Joseph asked me, personal finance involves a wide range of issues. So it involves the assets that we have got, the fixed assets, the liquid assets. It involves the liabilities that we have got. There are some liabilities which are okay to take. There are some liabilities which are not so okay to take, right? Then there are cash flows. So some of us are in business, some of us are in jobs. So we get salary, we get rental income, business income from various other sources. So cash flow is very important. Whatever is coming in and whatever is going out, the expenses. It also involves our goals in life. All of us have different goals in life, right? Some of us are having some short-term goals, some of us are having some medium-term goals and long-term goals. So it involves that also, because we have to plan for those goals, then only we can be sure of achieving them. It also involves protection of assets. For example, accumulating asset is one thing, but we also need to know and ensure that we are protecting those assets from some sudden emergencies, right? So it involves all these issues, and that's how personal finance management comes up, involving all such issues.
Thanks, Picasso. And you touched upon one point, and which I have emphasized multiple times in these sessions, is that every solution, every solution is contextual. There is no solution which is universal.
Right.
So all of these, with whatever that we are discussing, it's all coming from our standpoint, our stories, our journey, and we are openly sharing them. However, you will have to be careful to pick up what works for you, and apply it in the way that it will be applicable to you, rather than, oh, Joseph said this is kind of like, we should go and implement it, kind of a stuff. So I'm thankful for that. Again, you emphasized it, so thanks for that. One of the point that you talked about is, there are assets and liabilities, and one of the point that you said is there are some liabilities that we should not take. Can you go a little deeper on that? What kind of liabilities are dangerous for us from a personal front? What are those liabilities?
So, Joseph, I'm a banker, and it's my job to encourage people to take all sort of loans. Okay. But having said that, from a personal finance perspective, what we suggest is that we should take loans only when we are buying something which is appreciating in assets. For example, I am buying a house which I think is going to appreciate, and house loan also comes with tax saving, as we understand. So that loan is worth taking, even though there are some other issues involved, there are other factors, but in general, house loan is fine. Second is loan for education. So if I want to take loan for education of myself, maybe I want to build a new skills to my knowledge repository, so that's fine. Loans for education of my kids is fine, for my spouse is fine. But any other loans which is not going to utilized in a asset which is appreciating, rather it would be depreciating. For example, car loan. The moment I get a car, straight away, there is a depreciation of 20-25%. Nowadays, as we know, there are various kinds of loan. I'd like to talk about those in detail later. So I think those loans are either we should avoid. If we cannot afford without loan, probably we can defer it. Maybe we can build the assets and build our savings and then buy those things. Or if we have to take such loans, maybe we can try and ensure that we minimize the EMI liability as much as possible. So that's the basic ground rule.
Very good, Picasso. And let's segue into loans, because loans is one major component in everybody's life. So I'm a bit surprised, and then I mean, if you can, let's go deeper into that. Is that I understand the point that you're talking about cars. When you buy, as soon as you buy, it immediately reduces. So I understand it is not an appreciating value, but it is immediately depreciating. I'm assuming at least 50% of the people here, they will all have car loans. In that particular sense, how should we think about it? Again, I'm emphasizing the disclaimer that you gave in the front, in the beginning. We all have to have our own life. You have to apply what is applicable to you. But in general, can you go a little deeper into car loans? Because all of us buy cars, buy loans. How should we think about it? Even if we say we cannot, and probably it is also attached to another question, even if it is a loan that I'm taking for house, how much of EMI can I go for it? So two questions I have. One, how should I think about car loan if it is not an appreciating one? And two, how much of an EMI per month is okay for me?
So first, as I said in the earlier question, that we should try to minimize such loans which are not into appreciating assets. So if I have to buy a car, that is a necessity. So I have to buy a car. If I don't have enough savings, so I have to take a loan. That's fine. So number one, I take loan as little as possible so that I self-finance the car to the extent possible. Number two, I will try to prepay the loan as soon as possible. Let's say I'm taking a loan for 7 years. A housing loan can run for, let's say, 10-15 years because there is a tax saving involved. No other loans have any tax saving involved. So, and then also, compared to housing loan, all these loans, car loans, personal loan, our rate of interest would be much higher. So I'm ending up paying much more. So I should try to minimize the loan amount, number one. Number two, if I have to take the loan, I should try to repay it as soon as possible. What is the percentage of EMI that is fine? Again, it depends on person to person, but I think total EMI burden should not be more than 30 to 35% for a person. Total EMI together, because if I don't have liquidity surplus, for example, let's say I'm earning 100 rupees and I'm spending, let's say 40-50 rupees on my own expenditures. There are professional related expenditure, there are household related expenditure, there are some expenditures which are non-discretionary, for example, going for vacation and all those things are there. So if I'm spending 50 rupees out of 100 and I'm the rest 50 rupees, if I'm spending on EMIs, I don't have any liquidity. I don't have any savings for achieving my long-term goals. How do I achieve my retirement? How do I achieve my kids' education and other things which require a long-term planning and long-term investment? It will not happen overnight. So it's important.
Okay, so thanks for that. Again, I'm re-emphasizing this. Anybody wants to ask a question, you can put it on chat, or you can tell me, and you can unmute yourself and you can ask. Okay, so we talked about loans, and you are saying about 30% max of the earnings is what the EMI can be, and it makes sense from the example that you gave. It makes sense. At this point in time, you also talked about liquidity. So let's also talk about savings. Approximately, again, for an Indian context, now, are there any kind of a rule of thumb that it is better to have this much as a saving?
So Joseph, is again very personal, and there are people who are able to save as much as 60-70%. We'll talk about them later, the people who are following fire. And there are people who are earning lakhs of rupees, more than a lakh rupees. I know people because I keep discussing with my colleagues, and they keep referring and asking for my tips and suggestions. So I keep getting to know about other people's personal financial lives. So I see people, there are people in my friend circle who are earning more than a lakh, 1.5 lakh. Their saving, if you ask me, is zero. So it ranges from 0 to 70. That's how the broad it is. There are two things. It depends on the goals that I have got. If I don't have a lot of goals, for example, somebody may not have may not have family, he may not have married, right? So he do not require to save a huge amount of money because he do not have those goals which a married person would be having with the kids, right? If somebody is having a modest life, he need not require a huge sum of money for retirement. But if somebody is having already a good lifestyle, he wants to continue, he has to save for the retirement. So I think I suggest my colleagues and the young folks that I meet that maybe a 10% of my earnings early on, because my early on the salary is also less, right? So I cannot save a big chunk of my salary because the expenses and rental expenses, etc., have to be taken care of. Parents are there who need to be supported in many times. So early on, maybe 10% to start with is a great starting point. And once our salary increases, we have to make sure that our standard of living catches up less than our salary increments. That's a very important aspect, which do not happen, but we need to make sure that there is some check. And we, from 10%, maybe we try to increase a bit by bit, and so that we catch up with the goals. So 10% is a good starting point, I'd say.
Thanks, Picasso. And I want to share my journey as well. My first salary was 1,500 rupees. And at the 20, and then I'm talking about 95, something like that, and still it was very less. And by 25th or 26th or so, I will probably have about 10 rupees at hand, and I will have a masala milk, and then I will just go to bed because I didn't have money to have a nice dinner afterwards or whatsoever. I was not with my parents. I was working in Chennai at that time. And then after some times, it increased to 4,000 rupees. I was like, wow, this is fantastic. Now I can do whatever I want. And again, probably for 6 months, it was all fine. And then I learned to spend more money. So again, 25th of the month, I said, if only I will have 500 rupees more, I'm okay. I can spend this rest of the 5 days. And then 4,000 rupees become 15,000 rupees. 6 months, I was all fine. I was flying on fine. 6 months afterwards, same problem. That's when I said, this is not going to work. I can earn a lakh, 10 lakhs, whatever it is, but it is, unless otherwise I'm going to have some kind of a financial control, that this is not going to work. So that is when I started. I would save 10% of the money. It'll go into the bank. 10% I would give it away for church and charities and so on and so forth. And I thought my salary is only 80% of what I was earning. And I learned to live within that 80%. And that is what has taken me through all of these things. So I can understand what you are talking about. So thanks for that. Sarang is asking, now when we are talking about loans, nowadays in credit cards, Amazons and all of those guys, they give out 0% loan. Is it good to take?
So honestly, there is nothing called 0% loan. The interest cost is always embedded in the product cost. Because it's the highest interest rate loan that we are getting. All these consumer durables and all, because it's totally unsecured loans. Bank is not getting any security out of you. Bank is just giving you based on your credentials. Okay, you're doing this job, so you have got 1 lakh rupees of credit line. So it consists of the highest rate of interest just next to the credit card. So as much as possible, it should be avoided. Because what happens is, see, these are things which are designed by the product companies and the banks, the financing companies, to ensure that people who cannot afford those products, they get an opportunity to buy it. So of course, if I have to buy for example, a washing machine, which saves my time, I should buy it, right? But if I have to buy a laptop, probably I'll get a laptop at 30,000-40,000 rupees. But then because I'm getting a 0% loan, I'm buying a Apple product of 1 lakh rupees. So that's what happens. That's where the game is played, right? And there the margin, it is done in a way that the finance company gets a very high percentage of interest cost.
Wow. Okay.
That's how it is.
Yeah, I've seen this quite a lot. I didn't know this particular thing. Yeah, Sukhvinder, yeah, thank you, Picasso, on that. Okay, now let's move on to savings. KK, do you want to ask this question, please?
Yeah, thank you. So Picasso, happy to see you here. With interest rates on bank deposits and traditional financial institutions, interest rates are very low for deposits. So how should one go about? It's not even meeting the inflation numbers in some cases. So how should one go about savings, and what should be our approach to that?
Thank you, KK sir, for asking this. So really nice to see you here. Well, I'll say like this, that where we invest depends on two things. Number one, for what I'm investing. It depends on the goal, right? So I'll give you example. For example, I'm investing for building up an emergency fund. All of us should have an emergency fund, 6 months worth of expenses. If I'm trying to build up that emergency fund, I should invest into safest assets. Okay. I should invest into a bank account, saving bank account, maybe a fixed deposit. That's it. Maybe a recurring deposits. Recurring deposit is a very good way to build up a cushion like that. So I cannot take any risk. If I am trying to build up cushion or build up an amount for, let's say, house down payment, which is going to come up after 2 years, right? I cannot take any risk. I have no other option but to go for a safe assets like bank deposits, like debt mutual funds, etc. Now, let's say I am trying to invest for retirement, which is coming after 25 years. So there, what KK sir is asking, it is more important to understand that where shall I invest? Because if a period is very small time, let's say 1 year, 2 years, even if you get a huge interest or huge return, it will not make a huge difference because the period is very small. If it is a very large, it's a 20, 25, 30 years away, a goal, then I have a much bigger opportunity to take risk. And there I can invest into, let's say, equities, which is the best investment vehicle available. I can invest into direct equity. If I don't understand, for majority of us, mutual fund is the best option. So there I can take the volatility in the short term. It doesn't matter to me because I'm investing for 10, 15, 20 years.
Okay. So thanks. So in the short term, go for the safest.
Yes.
And for the long-term goals and long-term things, especially for retirement, you can invest in equity, direct equity. If that is not what you are suited for, then go for some form of mutual funds.
One more thing, there is another aspect apart from the time duration. There is something called risk appetite. There are some people who have experience or who have knowledge or who will not panic if the market crashes 30% tomorrow, because we have conviction on equities. So a little bit of knowledge, a little bit of experience, little bit of hand-holding or mentorship from somebody like you or Sukhbinderji helps the young crowd to get understanding of how it works. So if they have a conviction, they can be an aggressive investor and they can invest into these things. If I am somebody who is a very conservative, no, I do not want such volatility. I want safe asset classes. So there are asset classes for long-term goals also for conservative investor. Like we have PPF, right? We have our employees provident fund. We have our public provident fund. So such avenues are also there for such kind of people. But somebody who can take a bit of risk, I think equity is the best.
Understood. So the short-term goals are covered. It is very safe asset classes, which is probably RDs, FDs, and savings accounts. And you also mentioned about a rule of thumb of 6 months of emergency fund. So those are for the short terms things. And for the long term, equity in the form of either direct equity or via the mutual funds is what you are talking about. Now, Manish Sharma is asking, probably it's a little variant of the answer that you already gave, but the question is very specific there. Say, for example, we are planning for children education, which is going to come in about 15 years. And especially we are thinking about sending our kids to foreign countries or other kind of education. How should we think about and how can we start planning for that?
So there are some Excel calculators that are available online also that, for example, you need to understand how much is the cost for that kind of education in today's term, right? So then you have to find out the future value. So my kids will be going to universities, let's say 10 or 12 years after, since now. So I can find out the future value and how much is the amount that would be required from my investment. So I generally for such long-term goals, as I said, equity is the best option. Maybe a mix of debt and equity would be an ideal option. If I'm a moderately aggressive investor, maybe I can do a 70-30 ratio. 70% is going into equity mutual fund, and 30% maybe something like PPA for Shukanya Samriddhi if it's a girl child. Such things can be done.
Okay. So again, the essence of the point is, if it is a long term, so don't bother about the individual goals as such, in the sense of retirement or sending kids to abroad and everything. Think of it whether it's a short term or long term. And if it's a long term, it's okay to have the risk asset classes. And then we'll talk about that. But if it's a short term, the safe asset classes like FDs and those sort of things. So that's how we need to think. That's what you are saying.
Yeah, I need to add one more point here. There's a concept called asset allocation. So if we see, our friends and colleagues, we see there are a lot of discussions on where exactly to invest, which bank is offering a higher FD rate, which equity will perform, whether Sensex will give 20% return or 15% return. So there is a huge discussion on the stocks, the security selection. But before that, we need to find out the asset allocation. Now, when I say asset allocation, there are basically 4 asset classes that we have got. Number 1 is equity, we discussed. Number 2 is fixed income products. Fixed income products, again, we discussed like bank FD, PPF, which gives a fixed rate of return. Third is the commodities, the gold, right? And fourth is the real estate. We need to find out what is the percentage of my money or my portfolio, total portfolio, should consist of these 4 assets. Ideally, if somebody is young, let's say if somebody is 25, 30 or 35 years age bracket, maybe my equity should be 60%. Again, it depends on the goal, but I'm saying a broad parameter. Maybe 15% should be into my fixed income products, because I require some money for my emergency fund. I require my money for some short-term goals, right? Which will come up in 2, 3, 4 years, for which I cannot take risk. So I need to give some money into bank FDs, etc. And the rest of the money can be into gold, maybe 5% just as a cushion, 5 to 10%, not more than that. And then the real estate is also there. Now, what happens is we find either the real estate is the major chunk of somebody's assets.
Yeah.
Problem with real estate is that it's a big chunk of my money, right? So if I buy real estate early on, what happens? All my savings goes into EMIs in the early on. So I am not making any investment for the other goals. And here another concept is, which I would like to introduce, is a compounding interest. Many of you would know it. So if I straight away get a house, which is basically sucking all my money into EMIs, I am losing the first 5 to 10 years of my early career, where I could have invested into financial assets and get the benefit of compounding, which I totally lose out. So that's why real estate should not be a big chunk early on. Maybe once I have a financial assets cushion, then I can go for real estate. So that's how it should be. The asset allocation is very important. Another example I'd like to give is there are some people who invest into, they want to stick to PPF and insurance products. Insurance products means endowment plans, money back plans, because there's a heavily pushed products. They'd like to stick to this and they don't want to take any risk. Now, for investing for very long-term goals, if I am investing into only these fixed asset products, what happens is that not taking risk becomes a very big risk. I'll give you one example. Let's say somebody is trying to accumulate retirement savings. Let's say somebody is trying to build a 3 crore rupees fund.
Okay.
Right? Over a period of his entire career. Now, when I say 3 crore, looks a big amount now, but when I reach 60, let's say I'm 36 now, 3 crore would be like 1 crore equivalent, right? So it's not a huge amount. So I'm trying to build up an asset of 3 crore rupees, and I am starting, let's say, only with the fixed income products, right? Another person is starting with SIPs, mutual fund SIPs, equity mutual fund SIPs. So, the person who is starting with equity mutual fund SIPs, if he invests 10,000 rupees per month, he'll be able to achieve it when he is 60. Assuming let's say I'm 30, the other guy is also 30. So we are having a 30-year period. So with 10,000 rupees per month SIP, he is able to build a 3 crore rupees retirement fund. Now, what I have done is I have not invested in equity because I want to shy away from those. And I have stuck to bank FDs and debt mutual funds, PPF, etc. I will require 35,000 rupees to reach 3 crore. So 3.5 times I need to invest more, because I am losing out on the compound interest part of higher return. So that's the difference it makes. And that's why asset allocation is so important. Instead of spending all our time into security selection, which stock to buy and which cryptocurrency to buy and all these things, asset allocation is the most important.
Thanks, because probably that is one of the mistakes that I have done. And you touched upon very different points, and then we can dive into many of those kinds of points. And you also touched upon a hot issue, crypto. We'll come there. But say, for example, you talked about retirement, and usually we are thinking retirement is 60. What is your opinion about early retirements, and then the so-called FIRE, right? Financial independence at a much early time. Is it even possible in India? And then if so, how should we think about that?
So Joseph, FIRE is something which is very close to my heart. I have been trying to raise awareness on this FIRE movement because it's very new to India and most of us do not have any idea about this. Whereas it's a very big trend in US and Western European countries, where there's a huge tribe who are trying to follow FIRE. If I start talking about FIRE, probably the entire session will go there. So
we'll do a second session.
Yes, we can do it because there are various aspects of that. So just to cut the whole story short, I'll tell you with just one example that what is our most precious resources of our human life. The most precious resource of human life is not money, is time. Now if we think about our life, most of us in a job which is quite stressful, we are living for the weekends,
Mm.
we are living for once in a year holiday, that's it, once in a year vacation. So a lot of us start questioning that, is it what life about, is it what life is all about? So there are people like Vicky Robbins and all who have popularized these ideas in the West, and it's very slowly catching up in India as well. That if we if we try to value our time, right, and if we try to understand that whatever purchases we make, if we stop being a mindless consumer, and you for every purchase, a big ticket purchase decision, if we think that whether it will add real value to me, whether it will add real satisfaction, inner satisfaction to me and fulfillment to me, whether it will make me more productive or not, if we ask these questions, then we stop becoming an impulse buyer, right? The moment we stop becoming an impulse buyer, we have more surplus money to save and invest. So there are two ways we can think of. One is that we do a fire. Now, fire basically means financial independence, retire early.
Yeah.
Now, fire, I would like to emphasize on the first part, that is financial independence, and not on the second part, that is retire early, because retire early may not be our goal. We don't want to spend our time only holidaying. We need some productive work also. But then if we achieve financial independence, it basically talks about a situation where we stop depending on our primary source of income.
Mm.
We stop depending on our salary to run our family, to take care of our needs. We create a second source of income. It can be anything, or we invest for 10 to 15 years of our career. We save and invest properly, prudently, and we build enough cushion so that my investment income takes care of my expenses.
Okay.
So once I am achieving financial independence, then so many doors are opened. I can be anything and I can do anything with my time. So I have full control over my time. So that's the idea of fire.
Thanks. Because I think we have to either go get on our podcast, Gravitas Wins Radio podcast, or we need to have a second session. And how many of you would want session on fire? Can you do a thumbs up or something like that? Okay. Wow. Okay.
Yes, sir.
So I think we should have Picasso. So we'll have that. We'll plan it out. I think at least you have put that seed in the mind. So probably we should think about it. Yes, Picasso.
Now, there's a question I saw in the chat box whether it's possible in India. It's absolutely possible in India. It is possible in anywhere in the world.
Yeah.
It is more possible in India because the equity market is only booming. It is booming, in India, because all the structural reforms which are there in the West are only beginning to happen in India. So it's a very long-term bull market. I'm not a stock analyst, but when we talk about investment in fire, most people follow the equity market investments. So it's the best time to be in India to do fire.
Absolutely, I agree. And I mean, my way of looking at the financial independence and early retirement, my family says I'm already retired off partially because I only work 3 days a week. And the rest of the time I do things like this, spending time with I homeschool my kids, so spending time with my kids, or visiting friends like Sukhvinder and disturbing them on a Monday evening 3 o'clock, something like that. Okay. The point that you talked about is that when you have time, more what I call as dope reaches you. And I want to be really clear here, where I'm not meaning any other dope. What I mean as dope is when you have this kind of a time and when you are investing in these kinds of initiatives, what happens is you are able to attract dollars. That's the first thing, dollars. Second, you are able to attract newer opportunities, which is what Picasso talked about, additional sources of revenue you can bring in. So more opportunities reach you. The third thing is positions. Maybe some of these positions were not available, you were not able to do it. Now you are able to do that. So the positions, and the lastly, esteem. Picasso is here because I respect him. KK respects him. That's why he is here. And most of the people are here because we respect each other. So it brings you that that dope, dollars, opportunities, positions, and esteem. And I would believe I would highly recommend of thinking in that particular direction. And I think we should think about that. Okay, so let's move on to the other point that you talked about, Picasso. Let's say, for example, we are talking about the equity asset class. When we are thinking about equity asset class, I can, and let's say, for example, I am not, I'm a conservative, investor. I don't want to spend all my time looking at the tickers and so on and so forth. And I don't have that much of time to invest and track all of the stocks and which is doing fine and all of those kinds of stuff. From that angle, if I'm that kind of an investor, which is most of us are, right? Then what would you suggest? I know in the US there is this low cost. There's a particular term, I forget it. Low cost equity that ETF kind of a stuff. Are these available in India? Is there a difference between that and mutual funds? How should I think about it? How should I go about it?
So Joseph, what you are saying is basically called index. It's called index funds.
Yes.
And yes, there are ETFs and index funds are pretty much available in India. There are also some very good mutual funds which are in active space actually.
Okay.
Mutual fund, there are two ways which are done. One is simply mirroring the index. For example, we have Sensex, we have Nifty, we have other indexes as well. So there are funds like index funds which will just invest based on the parameters or based on the companies which are there in a particular index.
Yeah.
Like Nifty have 50 companies. So the particular index fund will invest only into those companies in the same proportion. So it's called passive investment. So because it's passive investment, so there is no fund management involved. And because there is no fund management involved, the cost is lower. Expenses is lower. And there is some very good quality investments into active mutual funds as well. So one can start either of them. See, in US and all, because there are so many research companies are US and especially in Western European countries, there are so many research houses. It's very difficult to beat the index, right? There are theories, random walk theory, etc. So because they are not able to beat the index, so they say, why do you give money to the mutual fund companies? You simply buy an index fund, right?
Yep.
And whatever is the market growth, you get that. India, there are huge asset management industry which says that we are able to beat the industry, able to beat the index. So you give me maybe 1% extra, I'll give you 2% extra. It is 1%. So both way there are different schools of thought. Maybe it can be a mix of both, or maybe somebody can start with index fund or active mutual fund. So you all your doubts over where to invest, which stock to buy, when to buy, where to buy, when to sell, all these things go away. You simply do a SIP and let it continue till your time. That's it.
Wonderful. So let's talk about the SIP. One of the questions that was asked is also, is it good to have SIP once a month, or we have SIP multiple times, and SIP in multiple different mutual funds or index funds? Okay, so for this particular discussion, we are going to keep them same, whether it is active or passive. So the question on the SIP is, should we invest the whole amount that we dedicate to the investment in one single SIP fund, or should we split it into multiple SIPs? Which one works better?
So there are different kinds of mutual funds. Even in equity mutual funds, there are funds which are large cap, which are investing into big companies like Reliance, HDFC Bank, etc. There are funds which are investing into mid cap, smaller companies. There are funds which are investing into small cap, very small companies, right? There are funds which are investing in all these three together. It's called flexi cap and multi cap funds. And then there are various industry specific funds. Like there's a fund called bank fund, which is investing only into banking and financial
Banks.
services. There are funds which are investing only into particular industry like IT, pharma, etc. So I think it's for someone who is starting, it's best to pick up a large cap fund, either index fund or an active mutual fund. Not one, maybe two would be fine. Let's say one large cap and one multi cap. It should be fine for someone who is starting, just starting. For other people, it depends on the goals actually. If the goal is very, very long-term goal, maybe you can take a small cap exposure because it's highly volatile. The return is going to be higher. The risk is also going to be higher. So it's based on that. For somebody who is starting, maybe one large cap should be fine to start with. There is no requirement to do it, different dates. One date should be fine. Maybe you choose 2 funds or 3 funds, one particular date, let it go. First of 5th of the month, fine.
Okay, wonderful. And what's the effect of tax on these returns?
Okay, so taxation, let me say one thing, that there is a category of mutual funds called ELSS. Many of you would know this, equity linked savings schemes, where you get tax saving. We have this 80C bracket, 80C in Income Tax Act. So under section 80C, you get up to 1.5 lakh of your investment, you get tax deduction. Your income goes down, the taxable income goes down. Other than that, for equity mutual funds, if you are redeeming your mutual fund in a particular year, if your capital gains, that is you're investing, let's say 5 lakh rupees, and you have sold it for 6.5 lakh rupees, right? All the funds together, whichever you are selling in a particular year. So your net gain is 1.5 lakh rupees, right? 6 lakhs minus 5, 6.5 minus 5. So out of 1.5 lakh rupees, 1 lakh is tax free. You don't need to pay tax on that.
Okay.
Remaining 50,000 rupees, you have to pay 10% tax. You have to pay 5,000 rupees tax. That's it.
Okay. Is it the same thing on if you invest directly on stocks?
Yes, it's same.
Okay.
But equity and equity mutual fund is same.
Okay. So we have another 10 minutes or so. Can we touch upon the crypto that is going on? What's your opinion on crypto? Should we invest in crypto? Is it legal now in India? It is going up and down on it. I don't know what's the status now. Can we invest in crypto? What's your opinion on this?
Okay, whether it's legal or illegal, I'd say it's not legal, it's not illegal.
Okay.
I'll tell you the background, and I'm sure many of the audience will know. There was a ban from RBI. There was an outright ban from Reserve Bank, and Reserve Bank have been taking the stance that it should be banned.
Yeah. I
know the government is probably not in favor because it may kill the evolution of this, and India may miss out, right? So what RBI did was in 2018 they brought out a circular saying that it's totally banned. It's illegal to do any crypto investment. Then Supreme Court struck it down saying that, no, you cannot ban it. So now it is not illegal. Is it legal? Well, RBI thinks that you should not do it. RBI governor himself has been cautioning time and again that please don't do it. That's number one. Number two, see, if you ask me, I am not a technology guy. No, I'm a finance guy. So I really do not understand cryptocurrency as much as some of you, for example, you may be knowing much better than me. So from that standpoint, I'm neutral.
Okay.
Right? Number one. Number two, if I am going to invest or if I have invested, I have not invested and I'm not going to invest.
Okay. Right?
Even if Bitcoin price goes up to 1 lakh USD or 10 lakh USD, doesn't make any difference to my principle and my philosophy because I'm not comfortable with this and I'm happy with my own portfolio. So I do not want to take this risk. That's number two. Okay. Number three, I have 2-3 fundamental issues with cryptocurrencies. I'll take it very quickly because we don't have much time. Number one is that there is no underlying assets of cryptocurrencies, right? So, for example, if I am buying a house or if I am buying equity, I have an underlying asset. I have a company, I have assets, I have a real estate. So I know there are valuation norms where I can value. I can see, okay, this value is maybe 20 lakhs. Market price is 30 lakhs. So fine, it's 1.5 times. I'm okay with that. In crypto, there is totally in the air. There is no underlying asset. The have no way to value it. That's number one. Number two, it's not regulated. As we know, in the financial market, even in real estate market, there is very strong regulation. Not in real estate to that extent, but in stock market and in banks, they're very, very tightly regulated. I'm in a bank and I see the RBI auditors and all extremely tight regulation on many parameters so that there is no failure of banks, there is no failure of stock market itself. There's a very strong regulation. And then there is a very strong grievance redressal mechanism by RBI. We have an ombudsman. So if bank is not giving me any, my catering to my complaint, I have a person to go, and I know my concerns will be taken care of. In SEBI, in RBI is there, but in here, if my money is stuck, I do not know where to go. Because none of these entities are regulated, so they have nobody to answer to. Right? There's no particular rule of law. There's no regulation, nothing. So there is no grievance redressal mechanism. I'm not comfortable with that. And number three, I think, which is more important, is that the most of the people who are buying into crypto, they're having a premise that someday it would be legal tender, which is very unlikely because no government and no central bank would be comfortable with that. We in one hand, whenever we are investing into money in banks or in stocks and mutual funds, there's a KYC mechanism, right? There's an anti-money laundering mechanism where they're trying their best to ring fence so that money from terrorism or illegal activities do not come in. So there's a clear know your customer rules. On the other hand, crypto has no KYC rule at all. Nobody knows what they are doing with the money because it's you understand this, how it works. So nobody would be comfortable because it's a huge problem to manage the monetary policy, to manage the financial stability. So I don't see any major economy other than small countries like El Salvador and all, where it would be going to be a legal tender. So all these reasons, I am totally out of this, but I'm neutral when I'm trying to recommend people, because if you understand risk, maybe you can allocate a percentage of your money, but make sure you diversify. Don't put all eggs into crypto because it's giving astronomical return. And also understand that with astronomical return, you're also taking the astronomical amount of risk.
Yeah.
So that's it.
As somebody mentioned here, I think it is Darshan who mentioned it. A person like Elon Musk can manipulate crypto. He puts in one tweet and it goes up, or he puts another one, it goes down. So you have absolutely no idea. You have no parameters or factors to analyze whether crypto will go up or not. I mean, it's all something that you hope for. And when you said, I think it's time to finish in that particular note. Even I don't understand crypto even though I understand the underlying technology, but I don't understand the psychology. So I am also staying away. I think it is Morgan Housel who said there's something similar to this. There are no bold investors. I am in that particular category. I'm old, so I'm not bold. So there is no bold investors. So I'm not investing in crypto. But when you talked about legal and illegal, I only remember, it is neither legal nor illegal in India. I only remember, and I will finish with that. I only remember in one of the movies of Kamal Hassan. For people who don't know, he's a popular actor in Tamil Nadu and in South India. See, in one of the movies, he will end with this: is that I'm not saying there is no God. I'm only saying that if there is God, it would be good. So we are still, even all the Tamilians or whoever seen that movie, we are still figuring out what he meant by that. So we will finish with that. Picasso, thank you very much for taking your time and answering all our questions. I used to think, in fact, I advised my sister and few other people. When I say advise, we talk and then she takes, what should I do? So we discuss. So I don't advise, we discuss. And I used to think I know a lot about financial instruments and asset allocations and so on and so forth. And believe me, when I say this, I learned quite a bit in this particular session. So thank you for sharing your knowledge and sharing your time with us. Sukhwinder, do you have anything to say before we end?
It was an insightful session, and whatever he has shared was quite valuable for me. One thing I want to share on buying a car, because that is something very common for all of us. I think we should buy a car when we should have the money with us, but I prefer buying it with the home with the car loan, and we should keep the money in our hands to keep that flexibility and cushion. And one more thing I can share, that whatever loans I take, my father has suggested me to uh, put the first three EMIs before even starting the loan, and that has helped me.
That's a very good point. That's a very good point. Thank you for sharing.
In time of urgency, you can have those cushion of 3 months. So that's from my side. My dad is with RBI. He was with RBI for 38 years, and from your trade only. Thanks a lot, Bhomik. It was great.
Wonderful. Thanks, Sukhinder, for sharing it. It's fantastic. KK, do you want to?
Shall I add something?
Yes, please.
Sorry, I interrupted KK. Krishna ji, if you want to say something, I'll say.
No, go ahead, KK. Sorry, go ahead, Kurana ji.
Okay. So two things. One, I want to say about the car loan, and second, I want to say about the home loan or property loan. Car loan, I have seen people taking car loan. They lose so many things when they take car loan. One, there is an EMI for car. Second, there is an expense for petrol. Third, there is an expense for servicing. Fourth, they start traveling a lot and spend money on that. So these are the four ways one should think before buying a car on loan. One, property, if you are having second property, or if you are having a property which you can rent out, then it is far more better to go in for a loan. What my strategy initially had been was, suppose if I'm buying a showroom, I will make the down payment of the amount के जो EMI बने उतना मेरे को rent आ जाए. So my tenant is paying the EMI, I'm not paying the EMI. The down payment is the payment I have made to the seller. After that, it is the tenant who is making the payment. That has been my rule for building properties. So these are the 2 points I wanted to make for the benefit of the audience. Thank you.
Thank you, Karunaji. Sharma ji, yes, please go ahead. You raised your hands.
Yeah, in fact, I also will do it now, because I when I was hearing this, I joined very late recently. So I thought, at that time, I don't know the gentleman. He was talking very nice. He was talking about cryptocurrencies. So I just thought about one thing. See, when you say talking about legal and illegal, this is how this thing works. If it is not illegal, it is legal. So I mean, RBI, as long as RBI has not banned it, yes, he was right. Very rightly he said RBI banned it, Supreme Court allowed it. But then, because I come from Ministry of Finance, where the policies things happen, but RBI is a regulatory thing. So their approach is that they are not against innovation. And if you say, what is the legal sanctity, what is the tenor behind the currency? See, there were, in old times, if you remember, it was actually the gold coins which carried the value of the value itself was there in the coin. Over a period, it was supported by gold standards. The currency was not value. Now, over a period, the currency became only digital entries. Now, see, when we talk of this thing saying that, okay, this doesn't have a legal tender, the basic definition of money still remains by Keynesian theory is money is what money does. Now, you like it or not, as long as crypto does an exchange for you, and it is cheaper in the sense that there are no intermediaries involved. You are able to pay with the same currency when you're in maybe US and when you're in Europe, if people are accepting it across borders, and it is not illegal. But as of now, I don't think hardly any. I mean, there are few who have banned it. I was only because I heard the crypto thing only, so I'm saying I'm not getting into the loan things. But the fact remains, this all has evolved over a period of hundreds of years, from where the value of money used to be the coin itself, from They are to the value of money being backed by a central bank, giving a guarantee that if you come, I'll pay you this much, which has never happened in last 300 years. If you remember banking, how banking started in 17th century was the robbers, the sea pirates, they had something they wanted to deposit somewhere so that the loot could be, whenever they want, they could withdraw. That is how the banking started in Spain. So this is an evolving place. When you say cryptos, you never know. And the RBI is right in its stance saying, we do not want to kill innovation. These are early days. We don't know. Yes, early days, many things happen. You are
Sharmaji, you gone on mute. I know Sharmaji. I worked with Sharmaji. He was in SBI.
Yeah, I am still with SBI. Only that I am now in deputation to Ministry of Finance.
Yeah.
Or all this. Yeah.
Oh, wonderful. So crypto is entirely a different topic. I think we should have a separate session on it.
Yes.
As I said, I am very, very positive about the underlying technology. I think that will change quite a lot of things that are going to come in. But what is being built on top of it, there is a lot of discussions around it. One of the examples that I can give you, Sharmaji, I don't disagree with you on that in the sense that there's a lot of innovation that's happening, but it is evolving and so on and so forth. There's a lot that we can discuss there. One of the things that I would say is, the Airtels and Vodafones and all the others who are building the fundamental infrastructure for internet, they claim I need to have a pie on what is being built on top of it. Netflix and so on and so forth. They're all becoming billionaires. I am laying the underlying network. I am not getting anything out of it. In fact, I am going on losses. So I should have a pie of their profit. And they seem to be valid. There is also an opposite camp in it, net neutrality. And we can debate all of this. Net neutrality, which says, that is not right. So similarly, it's the same case in crypto. So we can go debate on both sides of it. But I want to stop here because thank you very much for taking your time and answering all of our questions. And I think you have laid for me, I will tell you, you have laid a clear roadmap of saying, if it is a long-term goal, how to think about it. If it's a short-term goal, how to think about it. And if you are young, how to think about it. And if you are reaching to our retirement, how to think about it. That clarity is what is needed. Now, once that clarity is there, within it, I can go and play around in the way that I can want and within the context that suits me. So I think for me, that clarity is fantastic. And that alone is more than good enough for me in this particular session. So thank you because of coming in. Thank you, everybody.
Thank you
for
Thank
your
you.